anybody knows where our guest is, go shake him up. Tell him to come on out and join me and Carl. Hey, it's Saturday Morning Unplugged, your Saturday morning raw, unscripted radio show. We are live on Facebook. We are live on Zoom, and we are going to be live on Clubhouse here in a minute. Today's show is brought to you by My Core Intention and your focus guy. And I am Mike Morawski, one of your co-hosts, and I am joined this morning by my co-host, C. Gordon Moose, who we proudly call Moose, and are looking forward to another Saturday morning. Carl, what's up?
Not too much, Mike. How you doing?
I'm good. While I get this set up, would you just kind of like introduce our guest, Sarry, Ibrahim?
Sure, absolutely. So welcome everybody, and I know it's not St. Patrick's Day yet, Mike, but here in Chicago we're celebrating on Saturday. So I had to wear my hat and my green shirt, but happy St. Patrick's Day to everybody, and I hope everyone's safe and good. And today again we have a great guest. We're going to talk about all kinds of stuff, multifamily, and just in general, have a conversation about what's going on in the market and, how people get involved. And we'd love to hear your story, how you got involved. Tell us a little bit about your first contract, your first building, and some things that you think our listeners will enjoy. So, Sarry, thanks a lot for joining us. I think you're muted. I think you might be muted right now.
Hey, let me jump right in here real quick. I got a couple housekeeping things that I need to take care of. First, Let me reset the room. We're live on Clubhouse this morning. We are live on Facebook, and we are live on Zoom. Hey, good morning, everybody. Trevor, Dave, Sarry, good to see you. Glad that you're here. Hey,
morning.
Listen, it is early. Somebody go wake somebody up, rattle their cage, tell them that we're live up here this morning and to grab their coffee. We're going to cover some crazy stuff this morning. We got a guest that we're going to talk about banking on yourself this morning. Hey, do us a favor. Would you please go subscribe to us on YouTube, like us, follow us on Facebook, LinkedIn, Twitter. And listen, if you are not on Clubhouse and you want to be on Clubhouse, please DM me and I will send you an invitation for that, because that is the hot new app and the place to be right now. So, hey, it is Saturday morning. We are here live and we are joined by Sarry Ibrahim. Hey, Sarry, how are you today?
Hey, Mike. Good. How are you?
I'm good. Hopefully you are not in the same shape that my partner is in here this morning, because he was out kind of late, and look, he's still wearing the party hat from last night. So we'll get into that a little bit later, I think. But I think he was out pretty much all night. How about you? Did you get a good night's sleep?
Yeah. I'm also in Chicago too
Yeah, well, good, because you're going to have to carry both of us this morning. So why don't you just give us a little background on who you are, why you're here, and because this is just raw and scripted radio, and we kind of just do whatever comes up. So good morning.
Good morning. Yeah. So first, thank you for having me on. I appreciate it, and I appreciate meeting everybody. Kind of a little bit about me. I run a company called Financial Asset Protection. It's a financial services firm located in Chicago, and we help and service clients in all 50 states. And we pretty much focus on one type of concept. It's called the bank on yourself concept, also known as the infinite banking concept. Pretty much the ability to take control of your financial life and to be able to integrate it with other investments like real estate investing. And that's actually our niche. Our niche, most of our clients are real estate investors, real estate brokers. So we've niched down to that. And this is why I wanted to be on today's show to talk about this concept and how it can help people in the real estate business. I also just launched a podcast called Thinking Like a Bank, where we show people how to think like a bank using the same strategies and principles that banks use. But it's not exclusive for bankers or people in financial services. Pretty much anybody who makes money and wants to keep more of it can check out the show and learn more about how to do that.
That's great. And here's what's interesting is my co-host Moose is work for a bank, been in the lending industry for a long time. So you guys have a lot to talk about. I'm glad that you're here this morning. Hey, so Carl, how come you look a little glazed-eyed this morning?
Mike, why are you picking on me? I was actually pretty good last night. Tonight's going to be a different story, but last night I was pretty good. So, and by the way, the reason my voice is so raspy is you gave me that cigar. Those cigars kill your radio voice.
Hey, nothing like a Fuentes.
Yeah, there you go. So Sarah, yeah, I think this is a great topic because I think a lot of people really don't understand how the American banking system works and why that's so important when you're talking about, real estate and mortgages and everything. And, as Mike mentioned, I work for ABN AMRO, which is a big Dutch bank. I work for Washington Mutual, doing multifamily lending for years. And I worked with another private bank with a guy he was a real Wall Street whiz kid, and he was my mentor. He's now, I think, the on the board of a big bank and is doing really well. But it's great because a lot of people that get into multifamily, that's a mystery to them. They don't really even understand how mortgages work. And not only mortgages, but I'm very curious about your whole platform and your model because I love the idea of being your own bank.
Mm-hmm. Yeah, definitely. So it's called, just to kind of recap on it, it's called the bank on yourself concept, also known as the infinite banking concept. And it's kind of a counterintuitive approach. It helps people with financing and becoming their own source of financing, but it's kind of counterintuitive in the sense that it involves whole life insurance. It involves specifically dividend paying whole life insurance. So for those of you not familiar with it, there's pretty much two aspects to whole life insurance. One is the life insurance aspect, and the second is the cash value part. It's like equity in the policy. Now, as we are building up the policy, we design it so that way we emphasize more on the cash value and build up the cash value. Also, you have the ability to borrow against this now to be able to use. So this kind of, and to better explain the concept, I think it would be wise to explain the problems behind the banking system. So one of the problems is we finance everything we use, whether it's mortgages, credit cards, student loans, auto loans, everything pretty much we touch is finance, either through cash or through banks. And about 1/3 of every American that earns a dollar, 1/3 of that goes to service debt. So that's student loans, auto debt, mortgages, commercial business loans. And a lot of people are focused so much on the interest rate. They want to be in the low interest area. Their mortgages are 3%, auto loans are 4%, kind of in the 3 to 5% range. And that's where everybody's focused on being. But what people don't realize is that it's not the interest rate that you're paying, it's the volume of interest. It's volume of interest. It's how many times are you paying interest for your items over and over again. And this concept allows people to sit on the other side of the banking table because we're all in the banking industry. Everybody who makes money is in the banking industry. We use checking accounts, savings accounts, credit cards, mortgages, everything. We want to be on the other side of that by becoming our own source of financing. So utilizing this concept helps one do that.
That's really great. And how long does it? So do you have to go to a qualified company like a Mass Mutual or somebody like that, or can you tell us a little bit about that? I'm very interested.
Yeah, that's a good question. So there's about 1,200 insurance companies in the US that sell whole life insurance. But everything we're talking about here, the bank on yourself concept, also known as the infinite banking concept, is applicable only to 3 or probably 4 insurance companies that we could actually use it. So there's a checklist that one has to follow to make sure this is all implemented correctly. Like number 1, it has to be from a mutually owned insurance company. So what that means is the customers, the policy owners are also mutual owners of the insurance companies. They get back dividends from the premiums paid into it. So as the opposite of that would be a stock owned insurance company. So you need to make sure it's a mutually owned insurance company. And then number 2, you need to make sure there's something called the paid up additions rider. The paid up additions rider is a part you add to the policy that helps turbocharge or increase the cash value over time, because we are emphasizing more on the cash value part of the policy rather than the life insurance part. So we need to make sure they even offer the paid up additions rider, and we have the ability to increase that cash value over time. And then the third part is something called non-direct recognition. Let's say, for example, we have a whole life policy, right? We built it up. We have about $50,000 in cash value now. Now, let's say we want to leverage this cash value to use alongside a down payment for a mortgage, or to even finance a whole property. If there's a property for $50,000, let's say, for example, there is, and we can borrow against the policy and leverage that. Now, non-direct recognition would mean that when you borrow that money, the policy keeps growing and earning compound interest on that money as if you've never touched it, because you're borrowing from the insurance company, leveraging their cash value and using your cash value in the policy as collateral. And that's actually the only collateral you'll need to finance that, whatever it is that you want to finance. It's the only collateral you'll need. You won't need personal income, statements, any of that stuff that other banks would use. You would just use the policy itself as collateral. So that's non-direct recognition. And of course, the opposite of that would be direct recognition, meaning that when you borrow against the funds, you'll get a reduction of interest and dividends on your money because you have an outstanding loan. So you want to make sure it's non-direct recognition. So kind of just to recap, mutually owned insurance company, paid up additions rider, and non-direct recognition. This is how you can make this infinite banking concept work, and specifically within the real estate industry.
So I just want to make sure, Mike, and I'm sorry for this. I mean, I am monitoring the chat, Mike, and I'm sure we're going to have a ton of questions today. I hope from people, but real quickly, let me get your email real quickly. I just want to make sure, because I want to reach out to you and talk to you about this, and I'm sure our listeners will too.
Yeah, I'm typing it right now in the
Okay,
chat.
good. You're going to type it in. So, now, have you written a book? I mean, can we set this up through you, or how do people, I mean, do you have a checklist of the things because I wasn't taking notes there, but I mean, obviously it's a very specific thing. So, how does somebody, because I'm interested in doing this for myself. So how does somebody, figure this whole thing out?
So let me just interrupt here real quick. Carl, what you're saying right now is exactly the conversation that I had with Sarry when I first met him, when we first talked. We connected on LinkedIn, and I was like, wow, you're kidding. So I thought this whole concept was very interesting. Really quick though, let me just reset the room on Clubhouse. Hey, good morning. If you're joining us live on Clubhouse, this is Multifamily Unplugged. We are live on Facebook. We're live on Zoom. We're here every Saturday morning talking about raw, unscripted, multifamily real estate. Today, we have a little bit different of a twist. We're talking about how to finance your multifamily real estate through another process, banking on yourself. And we're joined by Sarry Ibrahim this morning. Sarry, go ahead.
Yeah. So to answer Carl's question, I am writing a book called right now, Thinking Like a Bank. It's a more of an ebook, and I'm going to give it away for free as a PDF. It should be ready next week, and you'll find that on our website at finassetprotection.com. Also, there's a book called Becoming Your Own Banker by Nelson Nash. And Nelson Nash, for those of you who don't know, invented the infinite banking concept. So his book is called Becoming Your Own Banker. And I can send you that copy for free, or send anybody that copy for free if they go to our website, finassetprotection.com. There's also a third book that I recommend. It's called The Bank on Yourself Revolution by Pamela Yellen. And Pamela Yellen invented the bank on yourself concept, which is similar to the infinite banking concept. So it's those three books that I recommend. And there is a lot that goes into this concept. It's not just you just buy the whole life policy and that's it. We do a full, thorough financial analysis with all our clients. And the financial analysis piece is arguably the most important piece of the puzzle. It's getting to know your financial situation and what you want to do financially, where you want to go, kind of your objectives on a 5-year, 10-year, 20-year level, and what are some of your needs and wants with that. After we get an idea of that, then we do the personalized solution. That's where we structure out a policy, or maybe even some cases more than one policy, depending on what we uncover in the financial analysis. And we present that to you and show you how it could be relevant to your financial situation. So it's not like everybody has the same whole life policy from the same company. There's 4 companies we use, and each company we use has about 10 different products. So there's many different ways, a lot of creative ways to use it. Some of our clients are hard money lenders and private money lenders. Some of them run syndications or manage investment funds. Some of them are real estate brokers and use this to launch or run their real estate brokerage. So a lot of different creative ways and intricate ways of using this, but it comes down to what the client wants to do and what they want to do with their money over time.
Here's what's interesting about this for me is that there's a difference between this and like a self-directed IRA, right? Because with the self-directed IRA, there's more, it sounds like there's a lot more regulations around how you can invest and where you can invest than you can with this type of process.
Absolutely.
Yeah. And I mean, do you have to go through a licensed agent, or do you have to go through a representative, or how do you actually go about setting one of these up?
So yeah, it has to be a licensed agent, somebody who's licensed, typically, depending on the state, mostly life insurance or health insurance, probably both life and health insurance. And to take it a step further, you want to make sure you're dealing with an advisor who's competent specifically with infinite banking or bank on yourself, meaning they know how to use dividend paying whole life insurance for self-banking purposes. And this isn't something that conventional insurance agents or conventional companies utilize on a daily basis. A lot of captive insurance companies don't know about this or can't even utilize this because they're typically stock-owned companies. So you need to. So one indicator is, like, for example, I'm part of a group called the Bank on Yourself Professional Group. So it's about 200 advisors in North America, the US, and in Canada. And I have a Bank on Yourself credential, Bank on Yourself Professional. So you want to make sure somebody has something like that. Or there's the Infinite Banking Group, part of Nelson Nash's group, Infinite. They call the IBC Professionals or IBC Network. They've gone through those specific credentials to make sure they know how to properly structure whole life insurance for self-banking purposes. So just because, if somebody has a life insurance license doesn't mean that they'll know how to structure this. If there's some downsides to doing so, if you do it the wrong way. If you do it the wrong way, you can have a tax problem in the future. You can have slow compound growth or slow growth at all in the policy. In other words, the fees will be too high. The policy won't grow as much, or a combination of both. There could also be some liquidity issues where if you set up the policy incorrectly, if you borrow against it, you'll have some sort of penalty for borrowing, or back to the direct recognition aspect of it. So it really takes it a kind of a professional to be able to properly structure these policies. And again, it's not the title of it. It's more about the function, what it could do. So we're talking about, life insurance, and it's not the most exciting thing, but it's about what it could do. And that's where the professional would come in.
Right. And then did you put your email in there? Okay, good, great. So if anybody wanted to learn more about this, they could email you, correct?
Mm-hmm. Yes, absolutely.
And Mike, let's get people throwing some questions up here, because I'm sure you have some questions. I have some questions, but I'd love to hear from our audience. And so, we're multifamily unplugged series. So how does somebody, first of all, first question is, how long does it take for you to get into a position where you actually have something to borrow against? And how do you use it if you're trying to finance, say, a 4 flat or 6 flat or like an 8 flat? How does that work?
Mm-hmm. It comes to the financial analysis. We understand where the client's at right now, cash flow, retirement accounts, income, other things like that come into play. And from there, we would build out the policy. So to give you a specific answer, it all depends. The cash value that's growing in the policy is proportional to the overall premiums paid into it. So if you, for example, are putting in like $10,000 a year into the policy, your cash value is going to be proportional to that on an annual basis. In the first few years, the fees are typically the highest with the whole life policy. So if you're putting in, for example, $10,000 a year, you could see maybe $6,000 in cash value in the first year. And then, but this is a long-term strategy. It's about taking control of your financial life on a long-term basis. So let's say, for example, by year 5, you're break even now with the amount of cash value you have and the amount of premiums you paid into it. Now, after that, the policy starts to outpace what you're paying into it. So you're paying 10,000, the policy is growing by 12,000. You're putting another 10,000, it's growing by 15,000 now. And over and over again, this happens. That's also happening. And then you also have the liquidity part of it. So at any time, there's a cash value column, and you could borrow up to 90% of that cash value column. So let's say, for example, just using even numbers, you have $50,000 in 1 year. You could borrow up to 90% of that cash value at any time by filling out one form. You fill out one form, you tell the insurance company how much you want, and it could be up to 90%. And you fill in that form, and they ask you, do you want it as a check, or do you want to directly deposit it into your bank account? You would put the checking and routing number you want it deposited to, and about 3 to 5 business days later, you would have the funds in that account. And then you could pay back the loan whenever you want. You can pay it back next month, or over a year, or over a couple of years. You can pay it back whenever you want. Of course, we recommend that you pay it back eventually, because once you're paying it back, then you have the ability to borrow again and to use it all over again. So, and then another thing too with the strategy is that it kind of has like a beginner level strategy, and then also like an experience level. So somebody who's beginning would start off with the policy, maybe putting in a few $1,000s a month or a year, depending on how much they make, the cash flow, back to the financial analysis. And then they would probably start maybe using the cash in there to finance their down payment. So, and banks also, when they ask you, where'd you get this, 20% down, they'll accept it, that if it comes from a whole life insurance policy, even though you're borrowing from a whole life policy, they'll accept it as your form of down payment, because it's your money and you don't technically have to pay it back. So it is an acceptable source of a down payment. That's probably the first step you could start off using this is in connection with other loans. And then as you're paying down the loan, and as you're building up the cash value, and as you're doing more real estate deals, then you could eventually do a second policy, a third policy, and we do 6-month reviews with all our clients. So the goal is to build up as much cash value in time throughout the different policies over time. And then it can get to the point where now you're financing all your deals outright directly from your whole life policies, where you're becoming your own mortgage essentially. And of course, that's more of like a black belt strategy. That's more of a sophisticated strategy, but it takes practice to understand the concept and how you can integrate it with the other resources you already have, the current cash you have, the current network you're in, the access to hard money or private money, the access to other money. So everybody has unique situations, but you can start off using it on a small level, and then all the way up to becoming your own mortgage, your own complete source of financing.
Can you dump $100,000 in there day one? Or, I mean, are there limits, and do the fees, is it a percentage of the amount you put in, or how does that, I mean, how can you do that? Is that like, talk a little bit about that?
So the first thing is you can get as much life insurance as far as life insurance amount, as much as about 25 times your annual income. So if you make $100,000 a year, you can get up to $2.5 million in life insurance. Now, depending on somebody's age, that would probably equal, I don't know, $100,000 a year, maybe in premiums, or probably maybe a little bit less, maybe like $75,000 in premiums that they would pay into. So that's one option you could do. You can do up to 25 times your annual income in life insurance. That's one metric they use. And then as far as the fees go, the fees are, I would say, from what I've seen from the cases I've built, if you're doing a policy that's paid up over 7 years, 10 years, 20 years, the cash value would probably be about 60% of the total premiums paid. And again, it depends. It could be a little bit higher, maybe a little bit less. But if you're putting in 100,000, your total cash value would probably be 60,000 in year one, meaning that in the first year, $40,000 went to service, $2.5 million in life insurance for that specific client, plus the other fees that go into it, the underwriting, the actuarial fees, the mortality expenses, that all these fees that the insurance company takes into place. But what I think makes this advantageous, and what makes it a little bit better than other savings vehicles, is that you have the ability to recoup that cost. So over the years, you end up getting your money back that you paid into it, plus more. So it's a sunk cost in the first few years. Like if you, for example, put in $100,000 in year one, and then your cash surrender value is $60,000 in year one, and then you walk away from that policy, you just took a $40,000 loss, and that wasn't really worth it to take a $40,000 loss in year one. But if you keep paying into the policy, eventually you get back all your cost basis, all the money you've put into it, plus the interest and dividends over again, plus the ability to borrow against it and pay back the loan on your own terms.
And in the meantime, you have life insurance, correct? I mean, that's
Yes.
also a life insurance policy.
Absolutely, yes.
So is it just a standard life insurance policy? You're paying those premiums. You never get those premiums back anyway, right? So if you go out and just get a standard $2.5 million policy, whatever you pay every month, you don't have any ability to recoup those either, right?
Exactly. Yes, you're absolutely right. Yeah, like for example, term life insurance. A term life insurance policy has a set period of time of coverage. It has a start date and an end date, like 10 years, 20 years, 30 years. And let's say you did, a 10-year policy for $2.5 million in life insurance, and you pay into it a few $100 a month. There's about 99% of term life insurance policies, actually more than 99% of them, don't make it to a death benefit. So if 100 people get term life insurance policy, more than 99 of them, or 99%, would not make it to, they would pay into the premiums, and the insurance company would keep those. One out of those 100 would actually pass away within that period of time, and the insurance company would pay out that life insurance amount. So in other words, it's 100% a cost. So if you're paying $200 a month, it's entirely going to the insurance company's money, and you'll never receive that money again. It's a sunk cost.
Hey, this is really interesting. And let me just reset the room really quick. If you are joining us, we're live on Clubhouse this morning. We're talking about multifamily. Multifamily Unplugged is the name of the show. We're here every Saturday morning, live on Clubhouse, live on Facebook, and on Zoom. So if you want to join us on any one of those platforms, you're more than welcome to. This is Saturday morning live, Multifamily Unplugged. This is where we talk about raw, unscripted real estate, multifamily real estate, how to buy it, how to be creative, how to do things outside the box, get you thinking a little bit different than you normally think. Carl, I think this morning you probably are thinking a little bit different than you normally think because of last night. Let me say this though, as bad as I got somebody trying to ask a question, so I'm going to try and hang on one second. As bad as I'm bothering you, I never go out to eat late, right? I'm usually done eating by 5 o'clock, 6 o'clock, but I figured, hey, we're going to get together last night, and I go out to eat at like 9 o'clock last night. I'm a little sluggish this morning. I had some pasta. The pasta was really good. It's good if you're going to go for a run the next morning and you're going to burn those carbs off. But I'm like sluggish. So, hey, this is all on you, Carl.
Yeah. So, Mike, are you ready for this?
No,
Sarry,
I'm not.
are you in Chicago?
Yeah, yeah. I'm in Lincoln Park.
Okay. Do you know Chicago pretty well or not?
Yeah, I grew up on the southwest side in near
Okay.
Orland Park, and yeah, I lived here my
Okay.
whole life.
So, Mike, I don't know if we can name the name of the restaurant you went to last night, but you ready for this? The party that we went to afterwards, I met one of the owner's sons at the party.
Uh,
So
nice.
it's up to you whether you want to mention it or not. But yeah, I met one of the owner's sons. I was like, oh my God, my buddy's at your dad's restaurant right now.
Really? Yeah,
Yeah.
we were at Tofano's. That's my favorite place in the city.
Yeah.
They have the best
Yeah.
pasta. They have the best sauce, and I love the place because you go in, it's a little menu. It's on a blackboard on the wall. Whenever somebody comes to town, a client or anybody, I always take them there. So it's a great place though.
Yeah. Sarah, have you ever
You
been
got
there?
Joey's son there?
Yeah.
Oh
Yeah.
my goodness. That's
Isn't that
so
funny? He was at the party. I'm like, you got to be kidding me.
That's so funny.
Well, he introduced himself and he said, he said his last name's Stefano. I'm like, oh, my buddy's at Stefano's right now over on Florney or wherever it is. And he said, oh, that's my dad's restaurant. I'm like, oh, that's hysterical. Sarah, you got to go there. It's a great Italian place.
Yeah,
And I don't think they take credit cards, right, Mike?
No, they don't take credit cards. So they have an ATM machine there though.
It's old school. It's old school.
Old school for sure. No, actually they do take Zelle and another one of the other platforms. But
Can you pay for your dinner with your whole life insurance? That's the real question.
Yeah, if they're willing to wait 3 to 5 business days to get their funds.
That's crazy.
But I mean, so I often tell people with real estate, don't hold your real estate in your own name, right? Either set up an LLC or set up a trust, right? If you're going to buy more than one property, I recommend a trust. If you're going to buy just one property, a single asset LLC, which means, I know you know this, but for those listening, it basically means the single asset is the building. And we used to call them like 638 West Garfield LLC. That was our building at 638 or 6901 South Prairie LLC. And the only asset in that LLC was the title of that company. So I guess my question is, can you operate things outside of real estate? Can you borrow that money to go buy a car, or can you borrow that money to go on a vacation, or can you borrow that money to pay for your kids' education, or are there restrictions on what you can use with the money out of your whole life plan?
Hey, can I say something real quick here? Hold on to that question. Sorry.
Mm-hmm.
Listen, when I always named my properties like that too.
Mm-hmm.
68th and Dorchester and names like that, right?
Mm-hmm.
But listen, when you think about it, how attractive is that? I mean, why would you not name it Walnut Place or, Dorchester Inn or, why would you not name it something that somebody might like, right? That would be
because I was a banker. I was a loan officer. That's how everybody.
That'd be like naming your kid, hey.
October 12th.
Yeah. Oh, no, Sarry, that's how you never forget his birthday, right? I mean, that's how we never forgot. That's how we kept track of the properties. We knew which LLC it was. It's like, oh, this check goes into 638. Yeah. Naming your kids. That's funny. Name them their birthday.
Like we say, this is raw unscripted radio. Every Saturday morning, 10 o'clock, we're here live on Clubhouse, Facebook, and Zoom.
So now I forgot my question. What was the question? I can't remember what the question was.
Oh, which can use the money for anything you want in the policy.
Yeah.
So yes, that's one of the advantages of it is when you fill out that form to request a loan from the insurance company, there's no question on there, what are you going to use the money for? There are no restrictions. You could use it for real estate, for business purposes, to go on vacation, to renovate the home you live in. So there's no restrictions on that, as opposed to like self-directed IRAs that have very tight restrictions, right? You can't personally invest that money in a business you own. It has to be like a separate LLC. You need a custodian to manage it. You don't have those same issues with a whole life policy and borrowing against it, which again is one of the advantages of it. Also, there's a lot of asset protection behind whole life insurance. So the money that's sitting in there, and it depends on the state you live in, but in the state of Illinois, there is this protection where the cash value that's sitting in there can't be leveraged in a lawsuit. It can't, it's not public information. It's not like somebody could sue you and find out how much cash value you have in your policy and then try to leverage that. So there's a lot of asset protection behind whole life insurance. And you could also, it's not like it's completely under the radar. You could, if you were, for example, needing to prove you're an accredited investor to go into a deal with a syndication and they wanted some sort of proof that you're an accredited investor, you could show them, if you have to prove, for example, your net worth is at least $1 million, you could show the cash value in your whole life insurance policy as proof of your net worth. So it's pretty cool because you could kind of prove your wealth if needed and hide it at the same time, so just to kind of protect yourself on both sides of that.
And so the money is, the account is actually at the insurance company, right? It's not at a bank or anything else.
Mm-hmm.
But this kind of sounds like you have a bank, it's like a bank account
mm-hmm.
that has an insurance component to it that you can borrow your own money. I mean, is what it sounds like. And then can you pay back like almost like a mortgage? Like, can you pay back, over a 3-year period, like making monthly payments? Is that, can you do that if you want to?
Mm-hmm. Yeah, you could do that by just writing a check every month to the insurance company, or you could set up like an auto draft for you could say for the next 36 months, take out $500 a month out of this checking account, and they'll do that on a recurring basis. So yeah, you could definitely do that.
That's really cool.
Mm-hmm. Yeah, and Dave,
Go ahead.
Dave asked a question: can you save income tax by using pre-tax dollars to fund the policy? So it's a little bit different. It's the opposite. So with whole life policies, typically you're using after-tax dollars, but the money's growing now tax deferred. And then when you take the money out, you're usually taking out the money tax-free. So it's the other way. Instead of saving upfront on taxes, you pay taxes on the money, goes into the policy, and then you save on the long run. So let's say, for example, you have $100,000 in cash value, and then next year you get an increase of $5,000 in the policy. It grows by 5%. You don't pay taxes on that growth. And then when you take that money out in the later years or whenever, as a withdrawal, for example, you also don't pay taxes on that if it's structured properly. This is true about 90% of the time. Sometimes it's called a modified endowment contract, where you have to pay taxes on some of the gains in the policy because of the way it was structured to begin with. But for the most part, we're talking about converting from, let's say you're in the 20% tax bracket to the 0% tax bracket. So you're going into a tax-free zone from the taxable dollars to the tax-free zone.
And is there a term? I mean, does this just go in perpetuity, or is there a term to it?
As far as the premium dollars you're paying into it?
No, as far as the benefits, like you mentioned, 90% of the term policies never. So is there a term to this, or is it just as long as you're alive?
Yeah, it's whole life. It's for your whole life, and there's a start date, and the only way the policy ends is if you pass away, or if you cancel the policy, you surrender it or stop making payments to it and it lapses. That's the only way. But one thing that's cool is what you could do is you could fund a policy, for example, for like 7 years or 10 years only. And then after you stop funding it, the policy is still there and it keeps growing. The cash value keeps growing and the life insurance keeps growing, both without any future premium dollars. So it keeps growing. So now the policy is almost like self-sufficient. It's kind of like buying a house cash, paying it up. And then after you buy it cash, the appreciation still keeps growing without any future mortgage payments or any future dollars going into it. Same thing with whole life insurance. You could do it that way too.
Interesting. And then, other question that we had from somebody is there an age? Can I set this up for my kids, or do you have to be 18, or what are the restrictions there?
Yeah. So there's 3 parts to the policy. There's the owner, the beneficiary, and the insured. The insured could be anybody between the age of 0 and like 90 years old. The owner is typically over the age of 18. It's like owning a business or owning a checking account, typically depending on your state, the adult age. And then the beneficiary technically could be anybody, again, between the ages of 0 and 100 years old. But it's recommended that they're over the age of 18 for trust purposes. And this is something an estate planning attorney would better be suited to answer. Because, for example, if you left somebody a 10-year-old child money, there's trust issues that come into place with that. And so that would rather be better to go towards a trust. But again, this is something an estate planning attorney would be better suited for. But yeah, we have a lot of clients that set up college savings funds for their children using whole life insurance. So what they'll do, for example, when the child's born at age 0, they'll start a policy, putting in like $300 a month, and they'll pay for it for 20 years. So by the time the child is 20 years old, they'll have like something ridiculous. It was like $80,000 in cash value that they could use. And then now that the children they could go to the policy, borrow against that to use for their college education. Instead of going to Sallie Mae or the Department of Education or other third-party banks, they can go to that whole life policy, leverage that, And then now they can pay that back over time. You can even change the ownership of the policy from the children or from the parents to the children when they're, 20, 24 years old. You can gift it to them. Like, for example, after they graduate college, you can say, hey, I'm going to turn this over to you. Now you got this policy. It's already paid up. You don't have to add any more premium dollars to it. You can access the cash value anytime. And you could use it to start your next business. You could use it to pay back the student loans. You could use it for whatever you want. So that is definitely a very popular option that a lot of clients do, is they use whole life insurance for college savings funds, as opposed to a 529 college savings plan that have restrictions, right? You get the tax advantages with 529 college savings plans, but you have to use that money for college. What if children don't want to what if they don't want to go to college? What if they want to start a business, when they're in their early 20s? They could use a policy for doing that. They could use it for college. They could use it for whatever they want.
Interesting. There was another question that came through about what's the minimum to get started? Is there a minimum to get started? And then do you have to make like a term life insurance policy? I think you make like every month you make a premium payment. Can you vary the question is, how much do you need to get started, and can you vary the premiums month to month?
Mm-hmm. Yeah. So it depends really on a lot of factors to the financial analysis part. But on a low end, like for example, I started my first policy with $300 a month. That's typically the low end, putting in $300 a month. But I also, to answer the second part of the question now, I also set up the policy so that way I can have room in it to add $3,000 extra per year. So I was putting in $300 a month, and then there was additional room in the policy to add in that extra $3,000. Now the extra $3,000 is creative because I could add in more towards the cash value to grow the cash value over time to earn more interest and dividends on that. But there's a cap to it in this situation of $3,000. If I added in, for example, an extra $10,000, then it would become a modified endowment contract, and now it's a taxable contract. So I want to kind of stay in the tax-free area, the tax-deferred, tax-free area, or the tax advantage area. So there's the limit. Now I did a second policy recently that's $5,000 a year. So I have now two policies and growing the cash value. And then probably I'll end up doing a new policy every year, just based on the way things are going right now. And yeah, you could definitely control how much. There's a minimum, maximum every year you need to maintain to keep the policy, but also to be able to add more in. And it could vary based off of how it's structured. One rule is the more you add. So the fact that I added in $300 a month and the room is $3,000 that I can add in, that $3,000 extra that I'm putting in is proportional to the overall premiums I'm putting into. Now, let's say I was putting in $100,000 a year. I would probably have, $30,000 leeway that I could add in every year on top of that, up to $30,000. So more leeway, of course, is based off of more of the actual premiums. They're proportional to each other.
So those limits are set when you write the policy, or they're set by the company, or are they set by the government, or who sets the limits?
Both. So actually all three. So they're set by, in the beginning, they're set by the company, and the company is setting them based off of what the government wrote as the 7-pay test or the 7-pay rule. So when you, for example, write up a policy, you do like, $4,000 a year, for example, it calculates it. It will say your 7-pay test is $6,100. That means that every year you cannot exceed $6,100, and the insurance company calculates this on its own.
Interesting. That's really interesting.
Hey,
There's another question. I'm sorry, Mike. There was one more question. How long has these been around? Has this been around for a long time? I mean, Mike, I've never heard of this. I wish I would have known about this 20 years ago.
Yeah, for sure. Let me ask you a question. It kind of goes along with what Carl just said about, I wish I would have known about this 20 years ago. Is the name of this bank on yourself? Is this your concept, your name, or is it something that's been around for a while?
Yeah. So Bank on Yourself was invented by Pamela Yellen. She trademarked the name. She also wrote the book, The Bank on Yourself Revolution. And it's also similar to the infinite banking concept, which was invented by Nelson Nash, and through his book, Becoming Your Own Banker. The concept, both infinite banking and Bank on Yourself, I think have been around for about 20 years, fairly new. But the utilization of cash value whole life insurance has been around probably since before the United States became a country. So probably over 300 years it's been around. Also, the utilization of annuities has been around for probably thousands of years. But this term infinite banking, Bank on Yourself, is fairly new. It's probably a 20-year concept. The companies we use, like one of them is Lafayette Insurance Company. They've been around for over 100 years. Another company is Security Mutual. Same, they've been around for over 100 years. And these companies have not only been around for over 100 years, but they've also been paying out death benefits, cash values. They've been providing loans, providing interest, dividends on their money throughout time. So We're talking very conservative, very secure ways of protecting your money and growing it at the same time.
Awesome. This is really interesting. And then so I set up trust. My kids are under 18.
Mhm.
And so I set up a trust for each one of my kids,
Mhm.
which is being, until they're 22, they can't touch anything in that. So can I set this up? Can I set a policy up for each of those kids and contribute to them?
Absolutely. Yes, you could do that. Mhm.
Okay. The real question, Mike, is what do I call them? do I name them after the birth dates?
Hey, hey.
Yeah. This is really great. And do you have a website? I mean, is this what, can I ask you, is this what you do for a living? I mean, is this what your profession is, or is this something that you do to help other people? And I don't mean to put you on the spot. I'm just curious.
Yeah, this is what I do full time. Yeah, this is what my company does full time. This is what I do full time. I am a bank on yourself professional. Yeah, this is what we do full time.
Okay, good. That's great. And do you have a website, or if someone wanted to learn some more about this, I mean, could they reach out to you and make an appointment with you or something, or how would they do that?
Yeah, I just added it in the chat, finassetprotection.com, FIN assetprotection.com.
Not to
and
be
your email
with FINRA.
Yeah.
Right. And your email is just SARRY, your first name at.
Yes. Yes,
Awesome.
correct.
Well, you'll definitely be hearing from me for sure.
Okay.
Hey, well, listen, let me just reset this one last time, because we are about to the end here. I can't believe it. We're in this deal again for 45 minutes this morning. But hey, this is Saturday Morning Unplugged. You've joined us live on Facebook or Clubhouse or on Zoom. Good morning to everybody who's here. Dave, Aaliyah, Chris, Larry. Good to see everybody this morning. Glad you're here. If you guys have questions, throw them in the chat. We'll get them answered. Make sure you grab Sarry's name and information out of the chat. Sarry, why don't you go ahead right now and tell everybody how they get a hold of you if they have more information.
The best way is our website. It's finassetprotection.com. You could also email me at sarry@finassetprotection.com. And then the best way is on LinkedIn. And I just added my LinkedIn profile in the chat.
Excellent.
Great.
Well, thanks for being here this morning. It was great information. Man, you're a wealth of knowledge, that's for sure.
Thank you.
And Carl, as usual, it's good to see you. And after getting your head shaved last night, though, that hat must move smoothly on the top, right?
Yeah, it'll be amazing if I keep this hat throughout the rest of the weekend, but we'll see what happens.
What are you doing tonight? No kids today?
No kids today, because this is the one weekend where my kids go, Dad, go have a good time. But a good friend of mine is having a really big blowout party in River North, and he's got a band, he's got a huge music studio, and it's going to be a lot of fun.
Okay. What time?
Yeah. And you guys are more than welcome. Sarry, I don't know what you're doing, if you're doing anything or not, but Mike, you're always welcome. It'll be a fun time.
Well, let's circle up after the show, and we'll figure that out. So,
Thanks,
all right,
guys,
hey,
for having me.
Thanks
on.
for
Nice
being
talking to
here
you guys.
today, everybody. Sorry, go ahead. I didn't mean to
sorry.
interrupt you.
No, I was saying thank you for having me on. I really appreciate it. Nice talking to you guys. It was nice being here.
Yeah, thanks for being here, Carl. As
Absolutely.
usual,